Dividends and other corporate distributions, what we're looking at here are those things we get from a company, dividends being the big one, but what is the taxability of these things that we receive, these distributions that we get from a company? We start with ordinary dividends. Ordinary dividends are taxable. These are the most common types of distributions from a corporation. And a corporation is paying ordinary dividends out of its earnings and profits. Okay, this is a distribution of the profits of the company, a distribution of the earnings of the company. And so the shareholders need to report these payments as ordinary income. Okay, so this ordinary dividend, this distribution that we get from the company, we are going to take that as income, as the shareholder receiving that dividend. Now, there are qualified dividends, and qualified dividends are a benefit in that they are subject to the same 0, 15, or 20% tax rates that apply to net capital gains. Now, there's based on what the original tax rate should have been. We can get either a 0, a 15, or a 20% tax rate on these qualified dividends. But the main thing is what qualifies as a qualified dividend. And to get these rates, we need to have a dividend that is paid by a U.S. corporation or a qualified foreign corporation, and the taxpayer must hold the stock for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date. We just need to have held it for a certain period of time, and that ex-dividend date is the date at which the change gets as to, or there's a change as to who gets the dividend. If the share is being sold, does the buyer get it or does the seller get to keep it? But these are just dividends that we're going to pay a lower tax rate on because it's not ordinary income. It's going to be taxed essentially at our capital gain rate. We may also have a situation where dividends are used to buy more stock. Some corporations have what is called a dividend reinvestment plan. And what this does is instead of the dividend being paid out to the shareholder in cash, that amount of money is used to purchase more stock in that corporation for that shareholder. And taxpayers who are members of this type of plan still need to report the dividends as income. Now, if the plan allows for the purchase of more stock at a price less than its fair market value, the taxpayer needs to report the fair market value of that additional stock as dividend income on that dividend payment date. And this would just be an incentive, really, that the company is saying, we'll take these dividends and reinvest it, and we'll give you a better rate, a better price for those shares than that fair market value at that time. We may also get distributions from a money market fund, and we need to report the amounts received from a money market fund as dividend income. Now, a money market fund is just a type of a mutual fund, but it's not the same thing as a bank money market account that pays interest. But money market funds are going to give us dividend income. We may also have capital gains distributions, and this reflects income that's paid or credited to the taxpayer's account by mutual funds and real estate investment trusts or REITs. Okay, and so this capital gain distribution that we get when we have our mutual fund or our REIT, we need to report capital gain distributions as a long-term capital gain, no matter how long we've owned the shares of that mutual fund or that REIT. And so mutual funds and REITs give us long-term capital gains. Now, we may also have some non-dividend distributions. What this is it's a return of our capital. It's a distribution that's not a payment from the earnings and the profits of a corporation. We can look at dividends as a return on our capital investment, but a non-dividend distribution is a return of our capital. They don't have any earnings and profit, and so the only way they can give us any money is if they're giving us the money that we paid to acquire the shares in the company. And so this is a return of an investment in the stock of the company, and it reduces the basis of that stock. And this non-dividend distribution is not taxable until the taxpayer fully recovers their basis. Okay, this is not income. They're essentially giving us back the money that we gave to them. And when our stock basis reaches zero, we're going to report any additional non-dividend distribution as a capital gain. Okay, at that point, it's not our money that's being given to us. It's somebody else's money being given to us. And whether or not that should be a long-term or short-term capital gain depends on how long it is that we've held those shares. Now, we may also receive stock and stock rights, and so a distribution by a corporation of its own stock or stock rights, also called stock options, are generally not taxable, and a holder of these options does not need to report them on a tax return. There are, however, some situations in which this distribution of stock dividends and stock rights may be taxable, and they're going to be taxable if any of these situations apply. First, shareholders have the choice to receive cash or other property instead of stock or stock rights. And so if it's a choice that we ended up with the shares instead of cash, it's going to be taxable. If the distribution gives cash or other property to some shareholders and an increase in the percentage interest in the corporation's assets or earnings and profits to other shareholders, it's going to be taxable. If the distribution is in convertible preferred stock resulting in a change of ownership, if the distribution is preferred stock for some common shareholders and common stock to other shareholders, or if the distribution is on preferred stock, those are going to be taxable distributions in those forms of stock dividends and stock rights. But fundamentally, if we get dividends from our company, from the company we've invested in, those dividends are going to be taxable. If we're lucky, we can get qualified dividends that are going to be taxed at a lower rate. But if those dividends that we're getting are distributions of earnings, distribution of the profits, it is going to be taxable one way or another.